Hello and welcome back to HBD Trading's fundamental overview. This week we're starting and recording this video a little bit later than we usually would. This is due to the risk that was, present due to the tariffs. And talking of that, that leads us nicely into the first section of the upcoming week, where we're looking at the general risk. So at the start of this week, there was a lot of tariff talk, and with that, the market has gapped up across the board pretty much. And in terms of the VIX index here, which measures the overall risk sentiment in the market, with above being 20, above the 20 line, signifying there's a lot of risk involved in the market. We can see that on Monday there we gapped up above that 20, and now we're hovering a little bit below it. The other main point to note is still there is tension and war in Europe and the Middle East, so that's something to keep in mind. Moving on to the US dollar, as I mentioned, the main theme in the markets right now is the threat of tariffs, but not only the threat, the actual implementation of the tariffs. So last week, Trump had threatened Mexico and Canada with 25% tariffs. However, both have reached an agreement with the US, and now there will be a delay for, I believe it's 30 days for each of them. So that will sort of subdue the market for this short period of time. This massive move, wick up and down, was off the back of those tariffs being implemented and then subsequently reversed and put on pause. Again, we're still expecting the US dollar to keep climbing, with this sort of overall risk sentiment from the tariffs leading to people investing in um, the safe haven currencies like the US dollar. So this is going to push us to the upside. There was a 10% tariff placed on the Chinese economy. However, China fired back their own tariffs, and later on in the week, there is expected to be a meeting with Trump and the president or the prime minister of China. So we'll see what happens there. Yeah, essentially, we're just looking for the dollar to keep moving to the upside. Moving on to CAD, as I've mentioned, the tariffs the last couple of weeks have been weighing the Canadian dollar down. However, on the implementation and then the subsequent reversal, we saw it go down rapidly and then rapidly come back up. So again, for now, we expect the Canadian dollar to sort of hover around here and essentially wait, and we'll see what happens nearer the time where the 30 days sort of grace period, if you want to call it that, is up. The CPI for the Canadian dollar or the Canadian economy has been converging around the 2% mark, and due to this, the Bank of Canada have announced the end of their quantitative tightening, so we're not expecting too much more movement from the Bank of Canada. So right now we're sort of expecting it to hover, although it is susceptible to moves to the downside. In terms of the pound, currently across the board there's recession fears and there is uncertainty due to Britain's debt levels. So these sort of things, the recession fear and the uncertainty, is leading to us at HBD Trading to believe the pound is more of a short compared to the rest of the market. There is a rate cut expected this week and a few more rate cuts expected throughout the rest of the year. The euro is one of our largest bearish positions. We, across the board, basically every metric is looking bearish for the euro, from a large amount of cuts expected this year, a seasonal tendency to fall against the dollar in Q1. Ultimately, we're expecting parity with the dollar, so we're expecting $1 to equal €1. And in terms of France and Germany, the two largest economies that make up the Eurozone, they're both experiencing manufacturing issues as well as political instability. And one of the main things at the moment, again, is the US tariffs. So Trump has threatened the Eurozone with tariffs, and as a result of that, that's really hampering the strength of the euro. Not that there was much to begin with. So again, we're expecting the euro to come lower below these lows and further. In terms of Switzerland, really, as you can see over the last 6 months, it's just been ranging in an auction, and this is just due to the interplay between the Swiss franc being a safe haven asset, and this has obviously strengthened the Swiss franc. However, the fact that the interest rates are so low, there are carry trades occurring, and this is sort of cancelling out that safe haven effect, and that's why we have a range in market. So potentially, if the Swiss franc value gets to these lows, there could be a good potential buy position. Apart from that, I wouldn't be looking to sell anywhere around this range just because it is at the lower end of this auction or range, whatever you want to call it. In terms of the Bank of Japan, they have recently indicated willingness to hike rates, and this again, out of the currencies that we look at, is an outlier, as all the other currencies and nations are looking to start cutting rates or are cutting rates. So Japan is looking quite strong at the moment. Um, at the recent meeting, they hiked rates, which was obviously a good thing for the yen's strength. And coupling this with the tariff fears, with the yen being a safe haven, that's also support and strength for the yen. So we're expecting it to continue moving to the upside against most currencies. The only one where we wouldn't really expect too much change is the US dollar, just because it is also very strong. In terms of China, not really looking to trade China as such. We use it more as an indicator for other currencies. So the tariff of 10% by the US, they fired back their own tariffs against the US, and this is, as I mentioned earlier in the video, going to be a key point at Trump and the Chinese president's meeting later on in the week. Recently, their manufacturing rate came in at 50.1, which is very, very slightly just in the expansionary zone. This is quite surprising, to be honest, considering the amount of stimulus and money that the Chinese government have been injecting into the economy. And so we feel that this is, highlighting the weakness in the economy at the moment. The People's Bank of China have also signaled rate cuts, which again is leading us to expect the value of this Chinese yuan to, move to the downside. In terms of the Australian dollar, as I mentioned in one of our previous videos, the Australian dollar is a Chinese proxy, so whatever affects China affects Australia. And with that and the 10% tariffs on that, we're expecting Australia to move to the downside. Coupling this with the expectation of the rate cut cycle to commence this month, and the the retail sales falling and monthly inflation pretty much not moving. We're expecting this just to be signaling a bunch of weakness to start moving into the Australian dollar. And finally, we have the New Zealand dollar. Again, that is a Chinese proxy, so the 10% tariffs will be negatively affecting the New Zealand dollar. As a result of that, and coupled with the recession fears, or actually, the New Zealand economy is actually in a recession, so coupling tariffs, a recession, and continued large and consistent rate cuts of 50 basis points, we expect the New Zealand dollar to just keep falling essentially. One thing to note is the interest rate is expected to reach around about 3 to 3.25% by the end of this year. So that wraps up this week's fundamental overview. I've tried to keep it brief and go into the main points. As always, nothing we discuss here is financial advice. This is our own thoughts on the market. I believe that Kevin is doing the covering next week's video. So if you have any questions about this video or any suggestions for next week's video, feel free to comment and we'll make sure to include them in the video. Thank you.